Hello, and welcome to the inaugural episode of Let's Talk Stocks. So, one of the big things that people are wondering about these days with the stock market is what's going on, right? It's early 2020, we've got the coronavirus taking place, and the stock market early in the year collapsed. Let's take a look at what that looks like. So, I'm looking at on Google Finance two different major market indices, the Dow Jones Industrial Average and the S&P. If we go and look at the Dow, just as an example, this kind of broadly represents the overall U.S. economy. Look what's happened over the last year, right? The Dow Jones was trading at just under 30,000 early in early to mid February. Then all of a sudden, people started getting concerned about the coronavirus. Now, what happened there? The Dow plunged from this 29 to 30,000 level all the way down to about 18,500, a little less than that, actually. Now, that's probably not a big surprise, right? Anybody who's paying attention understands that the coronavirus is a really big deal. It's shut down an enormous section of the country. It's dramatically impacted the ability of companies to make money, etc. So if we were to look at any of the alternative indexes, like the S&P 500, you'd see the same story, right? The S&P 500 gets to roughly 32, 33, 3400 and then collapses down, loses about a third of its value in a month. That's really significant, right? That means if you had $100,000 invested in February, all of a sudden, a month later, you've only got $66,000. Now, what's happened since that time? Well, the stock market started to perk back up. So what's going on? Well, the S&P 500 is really up about 25% or so off of its lows. We've gone from 22,000 or so, 23,000, up to just about 28,000. So up about 600 points, give or take a little bit, in a matter of the second month. What's the story here? Well, the coronavirus is certainly what dragged the market down. And so the issue is, from the investor's point of view, more than anything else, how long is that coronavirus going to stay with us? And then secondarily, how much of an impact is it going to have on profits? The reality is that big, steady, secular growth stocks across tech, healthcare, and consumer staples are really holding up pretty well. If we were to go back as an example and look at, say, Tesla, they illustrate this point perfectly. Look what's happened to Tesla over the last year. So if we just look year to date on Tesla, we see Tesla went from about $900 per share down to as little as 300, but it subsequently popped back up to 800 bucks a share. Tesla is really one example of the stocks that are holding the market together. People are excited about companies like Amazon, like Tesla, like Shopify, even like Google or Apple or Microsoft. And those stocks are holding up relatively well. These large companies tend to make up most of the index value that's out there, right? They have reliable access to capital and they can weather the coronavirus storm far better than most small businesses. For example, Amazon's $1.2 trillion market value now accounts for more than 40% of the entire value of the S&P 500's consumer discretionary sector. So it's probably not a surprise then, given the growth that Amazon's seeing, that it's helping to kind of it's helping to buoy that stock market, right? It's helping to go through and provide that extra support under the surface. Moreover, analysts are also forecasting relatively little in the way of a recession for most of the companies that are out there, right? If we were to look at something like Amazon earnings, what we see is that for a company like Amazon, as an example, they're holding it up together pretty well, right? Most of the market out there is expecting Amazon to do relatively well in terms of their earnings estimates, and that's what's helped keep Amazon's stock price pretty strong. Year to date, look what's happened to Amazon. It's actually up despite the coronavirus, right? Now, the reality is investors are probably also pricing in something of a speedy rebound in the economy overall. It looks like, especially compared to 2008, where there were a lot of structural issues, it looks like the coronavirus might be something that we can resolve a little bit faster. Does the economy open back up in May, June, July, even August or September? We're not exactly sure, but nobody's talking about the economy being in a funk for years and years and years like they were in 2008. So against that backdrop, the overall stock market looks pretty strong. Amazon is just one example of that. We could also look at Apple for another illustration of this. Now, certainly Apple hasn't done as well as Amazon. It's gone from about 325 down to 282, but that's much better than the $224 per share that it was trading at. Said differently, Apple's really increased its value by about 25% since late March. If you were to have bought into Apple March 23rd, roughly a month earlier than, say, the April 27th that we're at now, you would have made 33% on your money, give or take a little bit. That's pretty significant. So we've got a pretty fast rebound here in many respects. The other big factor that's coming into play is what we call market microstructure. Stocks are valued in the long term based on their earnings, but in the short term, technical factors, supply and demand for shares, the level of shares that are short, things like that play a real role in the price of a stock. So technical factors seem to be playing a role in the bounce that we see. There's a short squeeze going on here, which essentially is forcing investors who've been betting against the market to close out those short positions. How do you close out that short position? Well, a company like Apple, if you're shorting that, you're expecting the price to keep going down. As the price starts going back up, those short sellers are forced to close those positions, and that helps to bolster the stock in question. Now, of course, we also can't discount the importance of the Fed. The Fed has stepped in and really begun providing material support to the overall economy, and especially to Wall Street. The Fed has stepped up a variety of asset purchases, money markets, as an example, lending facilities to companies large and small. They've started buying bonds that they never bought before, things like municipal bonds and corporate bonds, in addition to their usual treasury bonds. So all of those factors are helping to bolster people's confidence in the bond markets. And in turn, that's giving people the confidence to invest in the stock markets as well. Finally, the reality is that most people, when they think about the stock market, they're thinking about the level of jobless claims. And if we look at jobless claims overall in the economy, what we're going to see is that there's been a tremendous amount of bad news. A simple Google search kind of verifies this, right? So NBC, Fortune, Market Watch, etc., everybody's reporting the same jobless figures. We're all looking at the same jobless claims, which are ultimately coming from the US government. And what those jobless claims show us is that over the last 4 weeks, roughly 26 million people have lost their jobs. So for the week ending April 18th, we had 4.4 million jobless claims. We've never seen anything like this before, not since the time of the Great Depression. This makes the jobless claims from 2008 look amazingly good, right? That's what this chart shows us. This chart shows that over the last year, prior to the coronavirus kind of coming along, we had jobless claims of maybe a couple 100,000 per week. Now the coronavirus comes along, and all of a sudden, we have jobless claims in the millions. So you might say, against that backdrop, how can the stock market be doing so well? Well, the answer is the stock market doesn't care about what's happening right now. That's not important. What's important is what's going to happen in the future. The stock market is looking past the current jobless claims and saying, hey, it looks like things are starting to get better. Yeah, 4.4 million is pretty awful when we look at this. But the previous week's jobless claims were 5.25 million. The 4-week moving average is about 6 million, 5.75, right? So we've seen jobless claims peak and start to come back down the other side. There's no doubt then that the stock market is not looking at what's going on right now, but they're saying, hey, what's going to happen in June or July or August? And they see good news on the horizon. And so because they see good news coming, they say, hey, if stocks are cheap right now, if they've fallen off a third from their value in February, well, hey, I might as well buy in now while they're cheap and then wait for the economy to start to rebound. The stock market is forward looking. So that's really why you see this kind of disconnect that so many people complain about between Wall Street and Main Street. Wall Street is perpetually being kind of forward looking. They're asking what's coming down the road right now, as opposed to the average consumer here on Main Street tends to think about what's going on right now. That means that sometimes Wall Street can be a lot more pessimistic than Main Street. Before the coronavirus was a big deal, say back in late February, Wall Street was collapsing. We didn't really have a big economic shutdown at the time, but Wall Street was getting very pessimistic before the average person was. Now, when everybody's really pessimistic and concerned and scared, smart traders, smart investors are looking past that fear and saying, yup, jobless claims have gone way up, there's no doubt, but it's not going to be this way forever. We're already starting to see jobless claims coming back down, and that's the trend that I care about. So the answer when we ask why is Wall Street so disconnected from Main Street, there's a variety of different factors. But ultimately, it comes down to the stock market having been hammered by the coronavirus. And it looks like there are opportunities being created. Keep this in mind as you think about your investing tactics and strategies going forward. Of course, you should always talk to a financial advisor to find out what the right choices are for you. Here's an important point to be aware of. Let's Talk Stocks is not here to provide you with investment advice. All investment strategies and investments involve risk of loss. Nothing contained in this video should be construed as investment advice. Any reference to any investment's past or potential performance is not and should not be construed as a recommendation or guarantee of any specific outcome or profit. You should always talk to a financial advisor to understand what the appropriate investments are for your specific needs.